Good morning, everybody. Welcome to Coffee with KPP Live, the show that's dedicated to providing you with advice for life so that you can live richly and work towards the life that you've earned. My name's Kyle Roy. I'm a financial advisor with KPP, and I'm really proud and happy to be joined with Matt Ferreri today. He's a vice president for Bright House Financial, one of the largest insurance companies in the country, and he is a wholesaler. He serves financial advisors throughout the region, and I'm really grateful to have him here because I've known Matt for a long time. I actually competed against Matt in my former life, but I say that with a real, it's a humility, because although I competed against you, Matt, I just always knew that if I met with an advisor that you had met with, that person had been given good advice, served well. We got along as competitors, and it's really cool that you're able to call on me and we're able to work together in this role. So thank you for coming on. Matt's a wealth of knowledge, and today we're going to talk about what wholesalers do. We're going to talk about how the interest rate environment affects insurance products and retirement income products. Yeah. And we're also going to talk about maybe some insight into what the Federal Reserve might be thinking, because you've got some great perspective there. So Matt, welcome, and why don't you tell everybody a little bit about yourself and what you do?
Yeah, so I mean, as you said, man, it's been an unbelievable experience being a wholesaler here. You know, the last 25 years of doing this business, working for some great companies, working with some great advisors, certainly with everything that's happened with respect to retirement planning, how much that whole concept has changed. You've got that unique perspective of having been, a service provider and now doing it. You're making the cake yourself. It's an awesome and rewarding career. So I'm blessed to have done it.
Well, so tell us a little bit about what a wholesaler does.
Yeah. So, I mean, we are a manufacturer. I work for, as Kyle said, Bright House Financial is what was at one time MetLife for many, many years, and they spun us off. So we, like AIG, for you, try to manufacture retirement products so that an advisor who's building a portfolio can de-risk the portfolio, for whether it's for income, whether it's for principal preservation, accumulation. We try to do it in a way that we skew the numbers in the favor of the investor. So it's done a variety of ways. There's a lot of new products. There's a lot of innovation that's had to happen in that space. So we try to educate the advisors. Hey, here's what we're seeing. Here's what we're looking at. And then the biggest thing too, and the part that I know that you enjoyed as much as I do, is just meeting with so many good advisors and hearing the different ways that they construct portfolios, the problems that they're facing, the way that they manage their clients. That part of what we do, when we do get to interact with the end client, that's really, really rewarding. So yeah, it's been great, man. I'm really fortunate.
So what's your territory?
So it's great. I mean, Bright House has been really, really nice to me. They've kind of let me design it over the years. I'm born and raised here in Louisville, so I call on what I call Metro Kentucky. Louisville, Lexington, Northern Kentucky, some Western Kentucky areas, and then I've got Southern Ohio, basically Greater Cincinnati, and some of Southern Indiana.
So what's really important about that is, as advisors, it's easy for an advisor to kind of get, tunnel vision almost. It's easy to come to the office every day, and we're so focused on our clients and who we're serving that you lose sight of what's happening out in the world, perhaps. And why it's so important to have Matt come in and other colleagues come in from other companies is because you are with advisors all over the region. On a daily basis. You probably have 3 or 4 appointments today after this, right?
I do.
So what's important about that is we're able to get the perspective of other experiences of advisors and their clients throughout the region, because although it's important to have a custom financial plan, it's so important to be able to recognize what's happening in the world, and you bring that perspective, which is really, I'm going to give a shout out, shameless plug here, is that why really our KPP firm is so unique, because we have offices throughout the region.
Yep.
And we're able to take those experiences of clients, whether they're in Clarksville, Tennessee, Nashville, Bowling Green, Somerset, Kentucky, and really use those combined collective experiences to build more customized plans for our clients. But what you bring and that perspective, Matt, is so valuable to us. So thank you for that. And for 25 years, you've been doing it?
Long time, man. Yeah.
You don't look like you could be doing anything for 25 years, man.
You know, it's as I said before, I've been incredibly fortunate with the companies and the people that I've worked with. So, and it's a business that keeps you young. You know, I mean, it's the innovation and the perspectives and insights. The industry's changed a lot, man. You know, you've seen that. So just in case in point, being able to do this type of interaction with clients and share information this way, it's powerful. It's great stuff. So
let's get into it, man.
All right, let's do it.
So what is your focus specifically?
Yeah, so we manufacture a variety of retirement products, primarily annuities. Life insurance has always been a big part of our diet. What we do there, long-term care products in the past has been some stuff that we've done. Basically, as clients' needs continue to evolve and the retirement landscape changes, we're going to talk about that in a second, how much that's changing. We just try to basically manufacture products that can fill in the blanks. You know, if it's someone that is not fortunate enough to have a pension in retirement and they need additional monthly cash flow, how do we manufacture a product that could complement a core portfolio to give them a monthly check? If a client is in the accumulation stage and they're concerned about the volatility they're seeing in the market, or rising interest rates are causing pressure on bond portfolios, we've seen that, right? For the first time in a lot of people's lives. We try to manufacture products that can again de-risk that portfolio. So it's great because you're always learning. There's so much that we can continue to learn, and that's why I love being able to do this. You
know, and for those of you that are thinking or asking us, maybe chomping at the bit to go into more detail, compliance keeps us from going into specific detail on products and services, and we always want to say every single investment that you know, we're not going to talk specifically about investments. Investments carry risk of loss. Make sure you're consulting with your financial advisor for specific product suggestions or advice that may pertain to your situation. So we're not going to go into any particular products or solutions today. But if you do have questions on what kind of products are out there, what kind of protection features you can incorporate into a plan, feel free to give us a call. Our information will be attached to the video. But working for insurance companies, we talk about how the business has evolved. Let's talk about the interest rate environment that we've seen and how interest rates impact specifically retirement planning vehicles.
Yeah, I mean, it is the elephant in the room right now for a lot of people. I believe most people that if you've been investing for any portion of your adult life, we've all experienced what we would consider to be bear markets. We've all seen the impact of outside factors on equity portfolios. What we're experiencing right now for many people is really a first, which is you have abruptly rising interest rates as a result of what the Fed's trying to do to curb inflation. And in many cases, fixed income portfolios, that's troublesome for them. It's, you know, the old analogy is the seesaw on the playground. As interest rates go up, bond prices come down, and so it's inversely. So, and it's across the board, especially when they're this abrupt, when they're this quick. You know, even you know, a TIPS portfolio, which is designed to really thrive in an inflationary environment, that's felt some pressure here lately. So, for us, we're trying to really make sure that we're coming up with stuff that is going to allow a client to maintain an equity position, because not only are rates rising, you're in an inflationary position. So for you to put your head in the sand and buy something fixed right now, even if you feel that it's maybe a better rate than you would have gotten previously,
people are celebrating 3% CDs at the bank.
And you're not really addressing the real risk in retirement, which is the fact that I need to make sure my money is worth as much in 5 and 10 years for my monthly needs as it is now. So it's a double-edged sword for clients. So we're really excited. There's some really neat stuff that's happening there. But yeah, I'd love to talk more about it.
Yeah. So the challenge that we see is from insurance companies, whether they sell life insurance, annuities, you name it, the interest rate environment is integral to product design.
Oh, yeah.
Because the higher the interest rates, the not only the greater the returns that these companies might be able to pass through in terms of fixed rates or income protection, but the more margin they're able to keep on the back end. So low interest rates, to your point, has been an extremely difficult challenge for retirees because the manufacturers of these solutions can't guarantee income streams or rates of return that are relevant in an inflationary environment north of 8%.
Right.
And then what's the analogy that I've been giving to clients lately is, if you're driving down the road, the windshield is 100 times larger than the rear view mirror. Mm-hmm. And in financial services especially, when we look in the rear view mirror, those investments that have produced income, mm-hmm. or those investments that have been relatively safe in the past, are probably not what will be most safe in the future. If we do see rising interest rates, that's going to be putting pressure on bonds. Annuities, that fixed protection vehicles that people may have bought at a 2% interest rate, aren't keeping up with purchasing power. So how do you foresee a rising interest rate environment helping product manufacturers in the future?
Well, I think you said it before. So, insurance companies by doctrine, by nature, don't invest their core portfolios in equities, right? They're investing in long dated fixed income positions. So as interest rates rise, the one industry that benefits probably arguably the most from rising rates is the insurance industry. We're able to make much more compelling products to fill in these blanks. So, you talked earlier about an analogy. The analogy that I would use right now is if we were to go out into a room of 100 people, and we'd ask, for those of you in the room that have been a homeowner in the last 10 to 15 years, what would you say has been the silver lining to interest rates falling the way that they have for you as a homeowner, mm-hmm. on your family? And undoubtedly, people would raise their hand and say it's been refinancing our home. Without question, when rates are low, I can borrow debt at such a price, and with the way that real estate's accelerated in value, there's many people right now that have unbelievably low mortgages, right? In many cases, the bank's almost paying these people to own their home when you look at the appreciation on the home. Conversely, when interest rates rise, that same home, maybe it's not as attractive, maybe it's not as affordable because it's costing you more. As again, real estate prices have continued to go up. But what you are able to do is you are able to refinance part of your retirement account now that you can get a higher guaranteed rate, so that you get more monthly income without as much risk, and now that gives you additional liquidity, mm-hmm. that you hadn't had before. So that's what's great. That's the silver lining to right now, is that we're able to really do some neat things in that respect, benefiting from rising rates.
That's great. Now, and it's going to be choppy at times, right? Yeah. So navigate these waters as we do see interest rates go up. Now, granted, it's never a guarantee that interest rates are going to go up, right? One of the past performance is no indication of future result. All signs point to interest rates going up. We have a Federal Reserve that's trying to stave off inflation, that have made it very clear that they're going to do everything they can. But one of the reasons why interest rates go up is that if we do go into a recession or a depression, that the Federal Reserve has levers to pull. And that's part of the challenge. Is when things get scary, we could see interest rates fall. Probably won't, but who knows? Who knows? So I think this idea, you said it before, of just like people refinance their mortgages on the way down, a rising interest rate environment could give clients or investors or retirees the opportunity to refinance their retirement income.
Yes.
On the way up.
Yes.
And making sure you have a portfolio that's positioned to be able to capitalize on that, I think is going to be a very, very important aspect of retiring over the next 5 to 10 years.
Yeah, it's a great conversation to have.
Absolutely.
Yeah. Yeah.
So let's talk about one of the reasons why we had this is you introduced our firm, mm-hmm. to this book. Mm-hmm. Tell us a little bit about this. If people are interested in the mindset of the Federal Reserve, the mindset of what we might be looking at, The Lords of Easy Money by Christopher Leonard. Tell us about this book, Matt, if you don't mind.
Yeah, a colleague of mine, and several of, actually more than one time, a colleague of mine, and then also a couple of my most respected and tenured clients had this book. It came out a couple of years ago, and Christopher Leonard has basically done an anthology of the background of the Federal Reserve and the role that it's played in controlling the American economy. And it's a great read. So you don't need to be a finance buff to enjoy this book, but it's unbelievably timely because it just talks about, from the different tenure of various Fed chairmen, how each of them saw and tried to manage the risks of the economy at the time and what they did based upon history, and then some of the stuff that was done most recently that was outside the box. You know, what Ben Bernanke did with quantitative easing really had never been done. So it goes into great detail about each of these characters, and it's fascinating to see, to leading up to now, especially to see what Jerome Powell's trying to do, and having seen his views in the past. It makes it much more easy to understand what is the Fed doing, why are they doing it. It's a very charged subject, right? We've got a lot of people in our industry who feel that, hey, this isn't being handled well, but this really gives you a really neat look at it. There's some great stats I'd love to share with you that come out of the book that I think everybody would enjoy.
Yeah, please.
Yeah, so you know, the Federal Reserve has been in existence since 1913, right? And not that anybody knows 1913, but back then there was over 2,000 different types of currencies still running through the United States. So for you to get from the East Coast to the West Coast, you didn't know what all you need in your coin purse, right? So they had to back the banking system, unify the monetary policy, and so the primary role was really backing these banks. You know, early 1913, we still had bank robbers. They still went to go rob banks, because that's where the money was. So the idea here was, let's back the banking system so that when there is an emergency, that we have a way to make sure that liquidity is there. But in the first 100 years, from 1913 to roughly 2008, they put about $1 trillion into the banking system in almost 100 years.
In 100 years, $1 trillion total was invested in the banking system. I'm glad you said that. Yeah, I love that.
So to put this in perspective, and then in 2008, when the financial collapse is occurring, and then Ben Bernanke's in office, and he says, hey, you know, I wrote a paper on this concept of quantitative easing when I was at Princeton. I think that we should put this out and maybe test drive this as a way to save the economy. And there were some pushback. There was one gentleman in particular that they highlight in the book, Thomas Honig, who was a Midwestern guy.
St. Louis, right?
Went to Iowa State University, and he had been in office at the St. Louis Fed under Volcker, whose approach during previous periods of rising rates and high inflation was, hey,
he didn't care what it took.
A bad loan's a bad loan.
That's right.
And so Honig's job was to go out to these savings and loans in the Midwest that were backing many of these farms and say, I'm sorry, we're not going to be able to back this loan. So he was always very cautious about the notion of releasing all of this capital, because being an economics nerd, he was like, listen, laws of economics don't change. You put this much money out, eventually you're going to have inflation. It's gonna lead to bad things.
And I loved how the author Leonard, like, Honig was a lovable guy. Like, people loved him in person, but he became the pariah of the Fed because he was the dissenter.
He was,
when everybody else was going along, and he turned out to be right, didn't he?
Well, yes.
Wait long enough.
Yes. Yeah. And another key figure in the book is Jerome Powell. I mean, Jerome Powell was also an early dissenter. After Honig stepped out and Powell came in, and Powell had been in private equity, you know, so he had a completely different take on it. But he also was of the opinion that, okay, we did quantitative easing, it seemed to work, it seemed to save the economy. But to go back to that stat I said before, so once they finally voted on it and agreed, they did 1.3 trillion in 24 months. So what had taken,
and that was in 2008.
That's right. So what had taken 100 years, they did in about 24 months. And you know, inflation really didn't show up. The economy really responded well. The equity markets took off, right? So they kind of continued this policy. What was supposed to be a fix kind of became commonplace.
Almost became a drug. I hate, for lack of a better term.
Yeah, you're right. So, you know, again, staunch economists were suggesting, man, at some point, I don't know. But the impact on the American economy was, you know, rates were lower. They didn't want banks to sit on that money. They wanted banks to loan.
That's right.
So everybody was able to pay down debt. The real estate market loved it. The equity market loved it. People had leftover cash.
Interest-free financing for the last decade. I mean, interest-free financing. You could get a grill, a lawnmower, whatever you want.
Yeah, and then you know,
we may never see that again.
And then COVID happened. You know, and then COVID happened, and we don't have anything that we can back test.
Well, let's put that in perspective, because I love the fact. So from 1913 to 2008, 1.3 trillion is what the Federal Reserve pretty much printed to inject in the economy.
Yeah.
In 2008, it was 1.2 trillion over an 18-month period.
Yeah, between 08 and 2010, over a series of moves, yes, they
So
basically doubled. They basically doubled. They matched that number.
Matched that number. What it took 100 years, they matched in 1 year. During COVID, $6.8 trillion was injected into the economy. Now, so this is
half of that in 72 hours.
$6.8 trillion dollars, 6 times the amount of money that was built into the economy over 100 years in 72 out, half of it in 70. Yeah. So let's put that in perspective, because this is the way I help people understand that. And if you've heard me say this before, pardon me, but 1 million seconds is 12 days worth of seconds. 1 billion seconds is about 31 years worth of seconds.
Okay.
1,000 billions is a trillion. So that means a trillion seconds is 31,000 years worth of seconds. Yeah. $6.8 trillion were injected into the U.S. economy by the Federal Reserve and other stimulus government, not just the feds.
That's right.
In a 24-month period, $6.8 trillion is about 221,000 years worth of seconds.
Right. Or to say it another way, okay, it's 1/3 of all dollars that has ever existed in the history of the United States of the country.
My gosh. So what's the natural outcome?
Hey,
who knows?
The stock market enjoyed it.
It sure
right?
did.
I mean, you see what happened. You know, we had record reaction with respect to that. So, but again, so now here we are. Fast forward to today, and you know, it's not just been this alone. We've had supply chain disruption. We've had other things, but now the Fed, he's made it real clear. He made it clear on Friday, right? He doesn't care about the mathematical impact on bond funds right now.
He being Jerome Powell.
Jerome Powell and the FOMC is hell bent on making sure that inflation doesn't run rampant, right? And what he's also saying, tongue in cheek, is that assets need to be repriced. So it could be rocky. Yeah,
and Matt, I mean, this book, to your point, The Lords of Easy Money, it's a great resource to really understand, to get in the head of Paul Volcker, who again was such a hawk at the Fed that literally would do whatever it took to be able to bring inflation down in the 80s, and he did. And we see a Jerome Powell that is a disciple of Volcker. Granted, it's just, thank you for introducing us to that book. And anything you'd like to leave us with about,
No. I think that this is a wonderful medium. I think that it's great you're doing this, man. I really, really do. This is people, there's so many ways to ingest content, especially on retirement planning, right, in the markets. So for you to create a medium like this that people can rely upon, I think is really neat, and to be part of it, I appreciate it. This has been great.
Well, thank you, Matt. We appreciate you, and we're really grateful to have you as a partner. Always bring great ideas, great energy. So thank you.
You got it, bud.
All right. Well, with that said, thank you for watching our show. If you have any questions about these topics or anything like that, give us a call at 502-394-0400. Our office in Louisville is located at the corner of Hurstbourne and Shelbyville Road. We've got the best view in town by far, in a way. Come up and see it. And if you are viewing us from our Clarksville office and our affiliate Dowdy Financial Group, our phone number there is 931-919-0947. For those of you across the region looking for help, give us a call. Think about us. And as always, have a great day. We look forward to seeing you soon. Bye-bye.